Welcome to Epsilon Theory Shorts. Today's video comes from the Ask Me Anything with Ben Hunt and his guest, Dave Nadig. The question is, do we know who the market makers are?
The market maker for all these ETFs, that's out there, that's public, we all know who they are?
So we don't know specifically, for instance, if you said Wisdom Tree's Japan Fund, who are the authorized participants? Mm-hmm. That is not a list that you can get. Those are private contracts between the fund itself, which is a legal entity, and each authorized participant. And those contracts are long and complicated and include things like, well, what happens if this person fails? Or what happens if it's a Friday and you put the order in at 3:31 and you were supposed to put it in by 3:30? And all of those kinds of service level contingencies are in those AP contracts. Generally, you won't see an ETF come to market without 2 or 3 APs already contracted and willing to participate. The larger funds like a SPY, effectively anybody who can is a market maker for that.
Right. But this gets to Rob's question, kind of that this all makes sense for the big, ETFs that are just, part of the market infrastructure, right. Literally, right? What about, and we can talk about the inverse, but even kind of for the tiny ETFs, this
right.
all
the wacky ones,
wacky ones, right. But this is all. It works the same for all of these.
It really does. The big caveat here is SPY is a bad example because it's too easy. Let's pick something that's a little bit weirder, like J&K. I know we wanted to talk a little bit about credit and things like that. That's a case where not everybody can trade all of that junk, right? There are very few people in the market other than Jane Street that can trade every single one of those securities effectively, keeps inventory, knows who to call. So what they end up doing, the issuer ends up doing is saying, well, okay, that's a hard portfolio. J&K is hard to buy. So you can just give us cash instead. Mm-hmm. They can choose to do that. Literally every day they can change what the thing they want delivered is. If they say, we don't want you to go buy the bonds for us, just give us cash. Well, then the AP's job is the easiest job in the world. All he has to do is figure out a hedge, right? So he might sell somebody a whole bunch of J&K he doesn't have and know he's going to have to do a create at the end of the day, which means he's going to have to come up with a bunch of money.
But it's just cash.
But it's just cash. And during the day, he can choose, and generally does choose, to hedge not being naked short a lot of credit. Maybe he just goes and buys HYG and sells J&K.
Wow. So, and this actually gets to the other question, I think, of Croissant's question. I mean, he's saying, do they actually buy stocks 475 through 500? The small stuff, and they probably do.
They buy whatever they're told to buy. So every day, the NSCC sends a note to everybody in the market, and it basically lists, this is the creation basket that you need to deliver in order to get shares. There is sometimes a separate basket, which can be different, which is the redemption basket you will receive should you choose to redeem, which is incidentally a portfolio management tool, right? So if you're running some active tech fund, you can say, my creation basket today is 100% Microsoft because I want to load the heck up on Microsoft and just bring it. And by the way, I don't want any Apple, so if you do a redemption, I'm just giving you all my Apple when you do a redemption. And they can choose what's in those baskets very disparately.
So this gives a lot of leeway for the authorized participant, right? The market maker, whether it's I'm taking cash, I'm taking these securities, I'm redeeming these others, and they're balancing that off, I'm sure, against their own book.
Yep, exactly, right. And generally, these activities, like the AP activity, is happening at sort of the book level of the firm. So they, some individual on the desk might be sitting here hitting the sell button on SPY all day long because it looks like it's too expensive. The risk desk upstairs may have come into the market this morning saying, we are $3 billion over on equities.
Right.
Sell everything, in which case they may just hold that naked for 3 or 4 days, and maybe they'll be balancing trades that cancel it out, but they're happy to own the negative beta into the evening because their risk desk said we want that out. So the mechanics change firm by firm and fund by fund. But ultimately, there is an enormous amount of flexibility for what the issuer decides to ask for. Mm-hmm. And that lets the issuer decide, okay, do I want this to trade really well or do I want this to track really well? If I want it to trade really well, I'm just going to tell everybody to do it in cash, because now the market maker's job's easy. He's going to keep the spread super tight. But that means that the portfolio desk the next morning has a bunch of cash to invest, and that creates slop in the trading.
So I want to say that. I want you to say that again.
Slower.
More slowly, right? Because let me paraphrase if I can. Right? So that distinction, the issuer, meaning the
BlackRock. Let's just say BlackRock can decide, do I want this ETF to trade a lot, to and
trade
tightly,
like water, right?
yeah.
Or do I want it to track the underlying perfectly? That's a trade-off.
That absolutely is. And for years, like a great example of this, two competing emerging markets funds, EEM run by BlackRock, VWO run by Vanguard.
Yep.
For years, they tracked the exact same index, literally the same version of the same index. And the only difference between the two of them was that one of them was heavily optimized and was always asking for the fully optimized basket. And the other one was basically just saying, just give it to me in cash. And so what you ended up happening was one of them traded at a really wide spread and tracked perfectly, Vanguard. BlackRock, the exact opposite. Right, traded a little bit, traded super, super well, high liquidity, just, penny wide all day long. Up or down 0.25%, quarter on track.
That's so interesting.